Hello everyone, welcome to the 84th episode of me learning how to trade in Forex. So in the last video, we went through what interest rates matter to Forex traders. A currency's interest rate is probably the biggest factor in determining the perceived value of a currency. Inflation is a steady increase in the price of goods and services. All the various central banks for each country. When interest rates are decreasing, consumer and businesses are more inclined to borrow, so boosting retail and capital spending, thus helping economy to grow. And for the opposite, interest rate is cut, which leads to higher economic growth and faster inflation. Oh, that's what we said. That's what I said. Never mind. When interest rates are increased, there's low economic growth, so there's slower inflation. Currencies rely on interest rates because these dictate the flow of global capital into and out of a country, and interest rate expectations, who decides it. So the Federal Reserve's dot plot shows like the predicted, I think, 16 members of the market committee, and like it shows what they think where a what's it called, where the interest rate is expected to go. Interest rate differentials. So interest rate differential, which is the difference between one country's interest rate and another. So if you're trading a currency pair, for example AUD USD, then the interest rate differential is AUD minus the USD rate. The nominal and versus real interest rates. Real interest rate is equal to nominal interest rates minus expected inflation. Nominal is the one that's written down before adjustment for inflation. And yeah, that's that. I just noticed, off topic, but I say a lot, so I'm going to try to cut down on that as well. Note to self. So yeah, that's a really brief summary of what we went through last lesson, and now we're on how monetary policy affects the Forex market. Date is the 24th. As we mentioned earlier, national governments and their corresponding central banking authorities formulate monetary policy to achieve certain economic mandates or goals. Central banks and monetary policy go hand to hand, so you can't talk about one without talking about the other. While some of these mandates and goals are very similar between the world's central bank, each has its own unique set of goals brought on by their distinctive economies. Ultimately, monetary policy boils down to promoting and maintaining price stability and economic growth. So monetary policy is used for promoting and maintaining price stability and economic growth. To achieve their goals, central banks use monetary policy mainly to control the following. So, central banks use monetary policy to control the following. The interest rates tied to the cost of money. Tied to the cost of money. The rise in inflation. The money supply. Reserve requirements over banks. Reserve requirements over banks. The portion of depositors' balances that commercial banks must have on hand for withdrawals. portion of depositors' balances that commercial banks must have on hand for withdrawals lending reserves to commercial banks lending reserves to reserve banks to commercial banks via the discount window interest on reserve balances that commercial banks hold. Interest on reserve balances that commercial banks hold. IORB rate. Right, there's a lot of terms that I do not know what the meaning of are in here. So, interest rates ties the cost of money. Okay, that's straightforward. Rise in inflation. Yep. The money supply. So how much money is out there? Reserve requirements over banks. The portion of depositors' balances that commercial banks must have on hand for withdrawals. So how much of the depositors' money that the commercial banks must always have in them, which are available for the customers to withdraw. Lending reserves to commercial banks. So how much the central banks can so the amount of money that central banks keep with them to be able to lend to commercial banks. Interest on reserve balances that commercial banks hold. Interest on reserve balances. Interest on reserve balances that commercial banks hold. So the commercial banks also gain interest on the money that they hold. So the interest for them. Types of monetary policy. Monetary policy can be referred to in a couple of different ways. Contractionary or restrictive monetary policy takes place if it reduces the size of the money supply. It can also occur with the raising of interest rates. So contractionary or restrictive monetary policy takes place if it reduces the size of the money supply. It can also occur with the raising of interest rates. Can also occur with the raising of interest rates. Contractionary or restrictive takes place if it reduces the size of the money supply. So there's less supply. So if there's less supply at the same increase, but with the same amount of demand, then that means the price of the currency is going to go up. Right? So the price of the currency is going up. What does it mean if the price of the currency is going up? It can also occur with the raising of interest rates. The idea here is to slow economic growth with high interest rates. Borrowing money becomes harder and more expensive, which reduces spending and investments by both consumers and businesses. The idea is to slow economic growth with high interest rates. Borrowing money becomes harder and more expensive. Reducing spending and investments by both consumers and businesses. Expansionary monetary policy does the opposite, I'm assuming. Policy takes place if it expands or increases the size of the money supply. Can also occur with the decreasing of interest rates. The cost of borrowing money goes down in hopes that spending and investment will go up. The cost was it? The cost of borrowing money decreases to encourage spending and investments. Accommodative monetary policy. Monetary policy aims to create economic growth by lowering the interest rates. Whereas tight monetary policy is set to reduce inflation or restrain economic growth by raising interest rates. Whereas tight monetary policy set to reduce inflation or restrain economic growth by raising interest rates. Wait, so aims to create economic growth by lowering the interest rate. Isn't that the same as the expansionary? Set to restrain by raising interest rates. So tight monetary is the same as contraction. Huh? Why did they repeat over here? What's the difference between these? Finally, a neutral monetary policy tends to neither create growth nor fight inflation. Neutral monetary policy tends to neither create growth nor fight inflation. The important thing to remember about inflation is that central banks usually have an inflation target in mind, say 2%. They might not come out and say it specifically, but their monetary policies all operate and focus on reaching this comfort zone. Central banks usually have an inflation target in mind, which might not be specified, but their monetary policies all operate and focus on reaching this target. They know that some inflation is a good thing, but out of control inflation can remove the confidence people have in their economy, their job, and ultimately their money. By having target inflation levels, central banks help market participants better understand how the central bankers, will deal with the current economic landscape. Let's take a look at an example. Back in January of 2010, inflation in the UK shot up to 3.5% from 2.9% in just 1 month. With a target inflation rate of 2%, the new 3.5% rate was well above the Bank of England's comfort zone. Mervyn King, the then governor of the Bank of England, followed up the report by reassuring people that temporary factors caused the sudden jump, and that the current inflation rate would fall in the near term with the minimal action from the Bank of England. Whether or not his statement turned out to be true is not the point here. We just want to show that the market is in a better place when it knows why the central bank does or doesn't do something in relation to its target interest rate. Simply put, traders like stability, central banks like stability. Bruce Banner prefers stability. Economies like stability. Knowing that inflation targets exists will help a trader to understand why a central bank does what it does. Central bank. Round and round with monetary policy cycles. For those of you that follow the US dollar and economy, and that should be all of you, remember a few years back when the Fed increased interest rates by 10% out of the blue. It was the craziest thing to come out of the Fed ever, and the financial world was in an uproar. Wait, you don't remember this happening? It was all over the media. Petroleum prices went through the roof and milk was priced like gold. You must have been sleeping. Oh wait, we were just pulling your leg. We just wanted to make sure you're still awake. Monetary policy would never dramatically change like that. Most policy changes are made in small incremental adjustments because the big wigs at the central banks would have utter chaos on their hands if interest rates changed radically. Just the idea of something like that happening would disrupt not only the individual trader but the economy as a whole. That's why we normally see interest rate changes of 0.25% to 1% at a time. Again, remember that central banks want price stability, not shock and awe. Part of this stability comes with the amount of time needed to make these interest rate changes happen. It can take several months to even several years. Just like Forex traders who collect and study data to make the next move, central bankers do a similar job, but they have to focus their decision making with the entire economy in mind, not just a single trade. Interest rate hikes can be like stepping on the brakes, whilst interest rate cuts can be like hitting the accelerator. But bear in mind that consumers and businesses react a little more slowly to these changes. This lag time between the change in monetary policy and the actual effect on the economy can take 1 to 2 years. So, lag time between change in monetary and the actual effects of on the economy can take 1 to 2 years. Here's a short video clip of Jerome Powell, the head of the Federal Reserve, United States Central Bank. Wait a second. Inflation is the steady increase in the price of goods and services. But why does it need to increase so as the economy grows, why does the thing have to become more expensive? What causes inflation? Inflation is a measure of how fast prices of goods and services are rising. If inflation is occurring, leading to higher prices for basic necessities such as food, it can have a negative impact on the overall economy. Inflation can occur in nearly any product or service, including need-based expenses such as housing, food, medical care, and utilities, as well as want expenses such as cosmetics, automobiles, and jewelry. Once inflation becomes prevalent throughout the economy, the expectation of further inflation becomes an overriding concern in the consciousness of consumers and businesses alike. Inflation can be a concern because it makes the money saved today less valuable tomorrow. Inflation erodes a consumers' purchasing power, can even interfere with their ability to retire. For example, if an investor earned 5% from investments in stocks and bonds, but the inflation rate was 3%, the investor only earned 2% in real terms. What drives inflation? There are various factors that can drive prices of inflation in the economy. Typically, inflation results from an increase in production cost or an increase in demand for the products and services. Cost push inflation. Cost push inflation occurs when the price rises because of production cost increase, such as raw materials and wages. The demand for goods is unchanged while the supply of goods declines due to the higher cost of production. As a result, the added costs of production are passed on to consumers in the form of higher prices for the finished goods. One of the signs of possible cost push inflation can be seen in the rising commodity prices such as oils and metals, since they're major production inputs. For example, if the price of copper rises, companies that use copper to make their products might increase the price of their goods. If demand for the products is independent of the demand for the copper, the business will pass on the higher cost of raw materials to consumers. The result is higher prices for the consumers without any change in demand for the products consumed. Wages also affect the cost of production and are typically the single biggest expenses for the businesses. When the economy is performing well and the unemployment rate is low, shortages in labour workers can occur. Companies in turn increase wages to attract qualified candidates. Wait. When the economy is performing well and the unemployment rate is low, shortages in labour workers can occur. But the unemployment rate is low though, so it's not like the unemployment rate is high. I guess there's always going to be shortages of labourers or workers, causing production costs to rise for the company. If the company raises prices due to the rise in employee wages, cost plus inflation occurs. Natural disasters, demand pull inflation. Built-in inflation and rising wages. Built-in inflation occurs when enough people expect inflation to continue in the future. As the prices of goods and services rise, people may come to believe in a continuous rise in the future at a similar rate. Because of these shared expectations, workers may start to demand higher wages in order to anticipate rising prices. and maintain their standard of living. Increased wages will result in higher costs for businesses, which may pass these costs on to consumers. Higher wages also increase consumers' disposable income, increasing the demand for goods that can push prices even higher. A wage price spiral can then be set in place as one factor feeds into another and vice versa. Wow, this is a really detailed article. Right, that's going to be sent to the read list. I need to brush up on my economics, which is not very good, but let's watch this video first.
Your opening statement mentions great exports, but you don't mention that our trade deficit has gone up by $60 billion in the last year. And I would point out that the entire economic establishment in this country has made it almost prohibited to discuss the trade deficit. And that's why we elected, that's why.
How inflation continues to run below 2% target.
The country elected Donald Trump president.
So the inflation is not at its 2% target, so it's below the 2% target.
President. Now, the chair of the subcommittee boasts that we had a good economy in 2017. He's right. We had Obama's fiscal policies, Obama's tax policies, Obamacare, Dodd-Frank, Janet Yellen's monetary policies, and her big balance sheet, and we had a great year. As a matter of fact, we've been on a roll since 2011. We were closing in on having a high enough employment rate so that we'd have a labor shortage and higher wages. We were going well, and so instead of continuing to be on a roll, we've abandoned those policies and adopted a profligate tax and spending policy, throwing away the budget caps, $1.5 trillion plus interest of the debt from the tax bill. But I think that we will still do well because our scientists, our entrepreneurs, and our workers are the best in the world, and they'll make up for all the mistakes we're making here in Washington. I see behind you, sir, the green shirts that call for full employment. And it's not enough to go with the economist's definition of full employment, say 4%. We need real full employment that causes a labor shortage and desperate employers bidding up the price of labor. And that is also consistent with the fact that many economists are saying that you should be aiming not for 2%, but 2.5% inflation. That's the kind of expansionary economy that will allow these folks to come back in fancy polo shirts with the same slogan on it in a couple years from now. Now, when we talk about some workers getting a $1,000 bonus,
lower corporate tax should boost productivity.
Yeah, few have. But a family of five's share of the increase in the national debt from the tax bill is $26,000. What greater proof do we need of the need for financial literacy in this country than that some charlatan can say, here's the deal, I'll give you $1,000, it's money in your pocket, and we'll just slap a $26,000 mortgage on your future. Now, Chairman Powell, in your confirmation hearings, you said that I believe that no bank is any longer too big to fail. I would point out that the biggest banks are bigger now than in 2008 when they came to us and said they were too big to fail. They would pull the entire economy down. We had to bail them out with $700 billion.
All right. I'm just going to skip what he's saying because I don't really understand some of it. And I think it's more important to just go through a lesson rather than watching him talk. So, right. What type of monetary policy would you say she's pursuing? Contractionary, expansionary, neutral?
And I'd point out that the Wall Street prices in to the value of the bank stock, but more importantly, to the value of their unsecured debt, an implicit federal guarantee, an assumption that they will be bailed out. So I'll have a number of questions for the record, but I will actually ask one for you to respond to. We've adopted these profligate fiscal policies, huge tax cuts, leading to a massive increase in the deficit number that's right behind you. Then we busted the budget caps. Is our monetary policy going to need to be more restrictive this year than it would have been had we not adopted these profligate fiscal and tax policies?
Thank you. So, of course, when we're setting monetary policy, we're focused on achieving stable prices and maximum employment. And in doing that, we consider many, many factors all around the global economy, et cetera. Fiscal policy changes can have an effect, and changes of this size can have an effect. And that can be seen, of course, in the path of policy. It's very hard to say in advance what that would be. But the answer to your question is generally we take all those things into account.
So the more profligate the fiscal and tax policies, the higher the interest rates you need to set? Yeah, all other things being equal.
I would just say our own job is to focus not on fiscal policy but on monetary policy, and so that's our frame of reference.
Thank you for evading my question.
Hey there, thanks for checking out CNBC.
What did you say? Thank you for evading my question.
Thank you for evading my question.
Okay. Right. That was a random video, but okay. Hawkish and dovish, differences between monetary policies. Thank you for evading my question. Differences between monetary policies. Whoa. We just learned that currency prices are affected by a great deal by changes in the country's interest rates. We now know that interest rates are ultimately affected by a central bank's view on the economy and price stability, which influences monetary policy. Central banks operate like most other businesses in that they have a leader, a president or a chairman. It's that individual's role to be the voice of the central bank, conveying to the market which direction monetary policy is headed. And much like when Jeff Bezos or Warren Buffett steps into the microphone, everyone listens. So by using the Pythagorean theorem, where a squared plus b squared equals c squared, wouldn't it make sense to keep an eye on what those guys at the central banks are saying? Using the complex conjugate root theorem, the answer is yes. Yes, it's important to know what's coming down the road regarding potential monetary policy changes. And lucky for you, central banks are getting better at communicating with the markets. Whether you actually understand what they're saying, well, that's a different story. So the next time Jerome Powell or Christine Lagarde are giving speeches, keep your ears open. Better yet, use the trusty babypips.com economic calendar to prepare yourself before the actual speech. Whilst the head of the central bank isn't the only one making monetary policy decisions for a country or a region, what he or she has to say is only not ignored but revered like the gospel. Okay, maybe that's a bit dramatic, but you get the point. Not all central banks officials carry the same weight. Central bank speeches have a way of inciting a market response, so watch for quick movement following an announcement. So central banks speeches have a way of central bank speeches incites market response. Therefore, watch for quick price movements following an announcement. Speeches can include anything from changes, increase, decrease, or holds, to current interest rates, to discussions about economic growth measurements and outlook, to monetary policy announcements outlining current and future changes. But don't despair if you can't tune into the live event. As soon as a speech or announcement hits the airways, news agencies from all over make the information available to the public. Currency analysts and traders alike take the news and try to dissect the overall tone and language of the announcement, taking special care to do this when interest rate changes or economic growth information are involved. Much like how the market reacts to the release of other economic reports or indicators, Forex traders react more to central bank activity and interest rate changes when they don't fall in line with the current market expectations. It's getting easier to foresee how a monetary policy will develop over time due to increasing transparency by central banks. Yet there's always a possibility that central bankers will change their outlook in greater or lesser magnitude than expected. It's during these times that market volatility is high and care should be taken with existing and new trade positions. Hawkish versus dovish central banks. Yes, you're in the right place. Tonight's match puts the LA Hawks up against the NY Doves. You're in for a treat. Wait, what? Whoops, sorry, wrong subject. We really just meant Hawks versus Doves. Central bank Hawks versus central bank Doves, that is. Central bankers can be viewed as either hawkish or dovish depending on how they approach certain economic situations. What does it mean to be hawkish? Central bankers are described as hawkish when they're in support of raising the interest rates to fight inflation. Are described as hawkish when they are in support of the raising of interest rates to fight inflation, even to the detriment of economic growth and employment. Even to the detriment of economic growth and employment. When they are in support of raising interest rates to fight inflation. In raising interest rates to fight inflation. So as the price is getting more, what's it called? As the price is getting more, as the price of goods and services are getting higher, interest rates are raised, which results in lower economic growth and slower inflation. Right, so slows inflation. Right, okay. So hawks. They are known as hawks and use words like tighten and heating up will be used. For example, the Bank of England suggests the existence of a threat of high inflation. The Bank of England could be described as being hawkish if they made an official statement leaning towards the increase of interest rates to reduce inflation, to reduce high inflation. What does it mean to be dovish? On the other hand, or claw, central bankers are described as dovish when they favour economic growth and employment over tightening interest rates. Central bankers are as dovish when they are in support of economic growth and employment to over tightening interest rates. Tightening interest rates, that means increasing interest rates, right? They also tend to have a more non-aggressive stance or viewpoint regarding a specific economic event, or action. They are known as doves and use words like soften and cooling down would be used. So, favor economic growth and employment over tightened interest rates. So, to fight inflation, they want to grow the economy and employment. They want to grow the economy and employment. So if economy and employment grows, to help the economy grow, interest rates are decreasing, boosting retail and capital spending. Yeah, but how does the doves fight inflation though? They can't just be... Would they be lowering interest rates then? But isn't... Huh? Most likely increase interest rates. But that means so if they're trying to increase the economy or help the economy grow, then they have to decrease interest rates. What? What does hawkish and dovish mean? Wait, and the winner is it's a tie. Well, sort of. You'll find many a banker on the fence exhibiting both hawkish and dovish tendencies. However, true colours tend to shine when extreme market conditions occur. What does hawkish and dovish mean? Here's a cheat sheet that summarises differences between the hawkish and dovish monetary policies. So hawkish, objective, decrease inflation. Dovish, stimulate economy. Right, so that means they would have to decrease interest rates, right? Monetary policy stance: contractionary tighten, expansionary loosen. So expansionary, increase the size of the money supply, can also occur with the decreasing of interest rates. Current economic growth: strong, weak. Current inflation: inflation increasing, inflation decreasing or negative. Interest rate: increases, decreases. Balance sheets: what is that? Reduce or expands. Currency effect: currency appreciates, currency depreciates. So currency gains in value, currency decreases in value. If you're animal lover and want to dig deeper into hawks and doves, check out the video below. Interest rates: so they increase interest rate, doves decrease interest rates. Current inflation: so hawk, inflation increasing, so increases inflation. But then it says objectives decrease inflation. Current inflation: so inflation increasing. What does inflation increasing mean here? Inflation increasing, inflation decreasing or negative. Current inflation: so if the current inflation so the current inflation is either in... What? I don't understand what this means. And balance sheets as well. Hopefully I talk more about that. Yeah. I don't know, to be honest. Would it say more in the next few lessons? Hopefully. If not, we can always come back to this and still current inflation. How does that inflation increasing? So the current inflation is increasing for hawkish, which means it's trying to, and the objective is to decrease this inflation. Whereas for the dovish, the current inflation is decreasing or negative, so the inflation is not as going up as it's so the inflation is not going up as expected. So to trying to increase that inflation, stimulate economy. To stimulate economy, that means lowering interest rates. And by lowering interest rates, by lowering interest rates, the economy grows. And as the economy grows, inflation comes with economic growth. Right? That's that what it means? Anyways, I'm going to leave this episode here. It's been a confusing episode. I will need to do some more research on economy and economics. I think it's just important for me to learn like what some of the terminology means and just need more knowledge on economy in general, so probably will need to do some research on this page, the economy page on Investopedia. That seems interesting. So yeah, in the next video we're going to go through fundamental factors that affect currency values. So thank you for watching this episode, and I will see you in the next one. Goodbye.